Hey everyone, welcome back to Corporate Decoder, the place where we turn corporate jargon into something your grandma could understand. Today we're diving into a report from Quartzsea Acquisition Corporation, and it's a bit like watching a magician pull a rabbit out of a hat, except the rabbit is money and the hat is Wall Street. This is a Form 8K filing, also known as a current report. Companies file these to quickly let investors know about big events. This particular one, it's all about Quartzsea going public, meaning they started selling shares of their company to the public. This can be a very exciting time for a company, a fresh injection of cash to fuel growth and new ventures. This report is dated March 26, 2025, but it mostly talks about events that happened around March 19, 2025. The main event is the completion of their initial public offering, or IPO. This is when a private company first offers shares to the public, and Quartzsea jumped into the market in March. So who is Quartzsea? They're a special type of company called a SPAC, or Special Purpose Acquisition Company. Think of them as a blank check company. They raise money with the intention of merging with or acquiring another private company, and then taking that company public without it having to go through the normal IPO process. It is a quicker way to go public. The company successfully launched its IPO, selling 7,200,000 units initially, and later selling a total of 8,280,000 because the underwriter used their option to purchase extra units. Each unit is a package deal. It includes one ordinary share of the company's stock and a right. That right gets you 1/5 of an additional ordinary share when Quartzsea makes its first big business deal. These units were priced at $10 each, bringing in a whopping $82,800,000 before expenses. That's a good chunk of change. Now, here's another piece of the pie. At the same time as the IPO, Quartzsea also did a private placement. This is where they sold units directly to a specific investor, in this case Blue Jay Investment LLC, also known as the sponsor Blue Jay Investment LLC, also known as the sponsor Blue Jay Investment LLC, also known as the sponsor Blue Jay Investment bought 31,900 units at $1 also known as the sponsor Blue Jay Investment bought 30 another 2,000 each, adding another $19,000 to the pot. What happens to all this cash? Well, $82,800,000 of it went into a trust account. This is basically a safe that's been set up to protect the money for Quartzsea's public shareholders. The money sits there until Quartzsea finds a company to acquire. This is a security measure that protects investors. Okay, let's get a glimpse of Quartzsea's financial snapshot right after the IPO with the audited balance sheet as of March 19, 2025. This document acts like a financial scorecard. It reveals what a company owns, what it owes, and the owner's stake at a specific moment. It's an essential tool for gauging the company's financial condition. This is a snapshot of Quartzsea's finances immediately after the IPO. This balance sheet is an overview of what they own, what they owe, and what belongs to the owners. Alright, let's dive straight into some numbers. As of March 19, 2025, Quartzsea had a massive pile of cash, 82,800,000 to be precise. This represents all the money they raised from the IPO and private placement, sitting pretty and ready to be used. That's the company's primary asset at this point. But running an IPO isn't free. Quartzsea spent $1,755,769 on what they call deferred offering costs. This covers all the expenses like legal fees, accounting fees, and underwriter fees associated with launching the IPO. Think of it as the cost of doing business on Wall Street. Now here's where it gets a little interesting. Quartzsea reports an accumulated deficit of $67,805. This doesn't necessarily mean they're in big trouble. It simply means that since the company was created, it has had more expenses than income. This is common for SPACs before they find a company to acquire. We have common stock subject to possible redemption at $82,800,000. It might sound scary, but it's just common with SPACs. It means that if Quartzsea doesn't find a company to merge with in a certain time, public investors can get their money back. So what's the big picture here? Quartzsea raised a lot of money with its IPO, has the cash in a trust for now, and now looking for a company to buy. It is a waiting game to see what they do with the money. Now let's put on our thinking caps and analyze Quartzsea a bit. SPACs are a bit of a mixed bag. On one hand, they can provide a faster route for private companies to access the public markets. On the other hand, they come with risks. The biggest risk, the SPAC might not find a good company to merge with and investors end up with their money returned, but without any gains. Quartzsea's strength is definitely the large amount of capital they've raised. This gives them significant purchasing power and flexibility in finding a target company. Their weakness, they're basically a shell company right now, with no actual business operations. Their success depends entirely on their ability to find a good acquisition target. A key opportunity for Quartzsea lies in identifying an innovative and high-growth potential company that is looking to go public. A notable risk is that the current market is a bit crowded with SPACs all hunting for deals which could drive up acquisition prices. In conclusion, Quartzsea Acquisition Corporation is in an interesting position. They've got the money, but now they need to find the right deal. Keep an eye on this one because their next move will determine their success. Thanks for watching this episode of Corporate Decoder. If you found this breakdown helpful, don't forget to like, subscribe, and leave a comment below. Let me know what other corporate reports you'd like me to decode. Until next time,